Introduction. Welcome to the session on using support and resistance. What is support and resistance? Support, a price level where demand is strong enough to prevent further price drops. Resistance, a price level where selling pressure prevents prices from rising further. These levels are essential in trading because they help identify potential reversal points or continuation areas. By the end of this session, you'll understand how to identify these levels and use them effectively in your trading strategy. Section 2. Identifying support and resistance levels. Support levels. Look for price points where the market has bounced upward multiple times. These are often horizontal lines on a chart at previous lows. Resistance levels. Look for price points where the market has reversed downward multiple times. These are often horizontal lines at previous highs. Key tools to identify levels. Historical price charts. Candlestick patterns, like long wicks near support or resistance. Psychological levels, like round numbers. Section 3. How support and resistance behave. Role reversal. Once a support level is broken, it often becomes a resistance level, and vice versa. Example, if a stock breaks below $50 support, it may face resistance at $50 on the way back up. Dynamic support and resistance. Moving averages. These act as dynamic support resistance as they change with price. Trend lines. In trending markets, upward or downward sloping lines can act as dynamic levels. Strength of levels. The more times a level is tested without breaking, the stronger it becomes. Strong levels often lead to significant price reactions when broken. Section 4. Using support and resistance in trading entry points. Buy near support levels during an uptrend or range. Sell or short near resistance levels during a downtrend or range. Stop loss placement. Place stop loss orders slightly below support or above resistance to limit potential losses. Example, if buying near $100 support, place a